We already have 3 people watching. That's awesome. Hit that like button when you come into the live stream. The YouTube algorithm will pick up the video, spread it around for more people to join in. It's always more fun to have more people joining in on the live stream to make the comment section much more enjoyable to read and go through. Okay. Gonna talk about inflation. Where did it go? How come we don't see the inflationary scenario that everybody had anticipated was going to destroy the dollar, considering how much money had been printed? Now, I have a tendency to look back in time, go back to areas of the economy in which that we should have expected inflation but did not receive the inflation that we had expected, and I generally go back to the great financial crisis to prove this point, that the Federal Reserve took the balance sheet of $850 billion to over $4.5 trillion and failed to produce the inflationary scenario that they were looking for. So I left down in the description to the Federal Reserve website. This is the St. Louis Fed, and the title of this is "What Does Money Velocity Tell Us About Low Inflation in the U.S.?" And this was given September 1st of 2014. So it's an old article. It's not necessarily reflecting what has occurred just recently, but I think the issues that they were talking about back in the day still pertain to what it is that we have going on right now. So I'm going to read through some of this document, and it's not very long. Like I said, I left a link down in the description for you guys. And it goes like this. Inflation is typically described as the persistent increase in the general price level, such as in the Consumer Price Index. One of the most important theories to explain inflation is the monetarist view that, according to Milton Friedman, inflation is always and everywhere a monetary phenomenon. In other words, inflation occurs because there is too much money available to buy the same amount of goods and services produced in the economy. This view can also be represented by the so-called quantity theory of money, which relates the general price level and total goods and services produced in the general period, the total money supply, and the speed, the velocity at which money circulates in the economy and facilitating transactions in the following equation. And then they have this equation that they go through. Now, based on this equation, holding the money velocity constant, if the money supply increases at a faster rate than the real economic output, the price level must increase to make up the difference. According to this view, inflation in the U.S. should have been about 31% per year between 2008 and 2013. Now, again, this was the quantitative easing that was going to destroy the world, and I know I was one of them who was screaming hyperinflation at the time. When the money supply grew at an average pace of 33% per year, and output grew at an average pace of just 2%. Why then has inflation remained persistently low, below 2% during this period? Now, it goes on to say, declining velocity. I left a link down in the description that also shows to the M2 velocity. This issue has to do with velocity of money, which has never been constant. That's important to remember. It's never been constant. And so when they say, hey, we got a constant velocity and all this money printing takes off, that constant velocity isn't constant, right? So all this money printing has to go in accordance to a constant velocity that would then cause the hyperinflation scenario that we had all anticipated. If for some reason money velocity declines rapidly during an expansionary monetary policy period, it can offset the increase in money supply and lead to deflation instead of inflation. Right? See, all this money printing, just because the money printer goes off doesn't necessarily mean it's going to cause inflation. Money velocity has a lot to do with this. They go on to say, the velocity of money can be calculated as the ratio of nominal gross domestic product to the money supply, which can be used to gauge the economy's strength or people's willingness to spend money. When there are more transactions being made throughout the economy, velocity increases, and the economy is likely to expand. The opposite is true. Money velocity decreases when fewer transactions are being made. Therefore, the economy is likely to shrink. See, this is important to understand, that just because the money printer goes off doesn't mean that transactions are increasing. Think about all the home sales that have declined. Like the lowest amount of home sales in like how many years? All right. Again, that's money velocity coming down. During the first and second quarters of 2014, the velocity of the monetary base was at 4.4, the lowest pace on record. This means that every dollar in the monetary base was spent only 4.4 times in the economy during the past year, down from 17.2 just prior to the recession. That's how slow the money velocity had actually occurred during this time. This implies that unprecedented monetary base increase driven by the Fed's large money injections through its large-scale asset purchase programs has failed to cause at least 1-for-1 proportional increase in the nominal GDP. Thus, it is precisely the sharp decline in velocity that has offset the sharp increase in money supply, leading to the almost no change in nominal GDP. Right? This is, again, like, this is the stuff that nobody really tries to internalize, is like, why didn't it happen? Everybody says, oh, they're just lying. Oh, okay. You can just assume that they're lying and then not internalize what was actually happening, right? Or we can understand that the velocity of money has dropped dramatically. And even today, it's incredibly low. Now, it has increased, but still, the increase that has taken place over the last few years is still persistently below what it had occurred prior to COVID pandemic. All right. So why did the monetary base increase not cause a proportional increase in either the general price or the GDP? The answer lies in the private sector dramatic increase in their willingness to hoard money instead of spend it. Such an unprecedented increase in the money demand has slowed down velocity of money, as in figure below shows, and there's a chart that shows it in here. All right, and why then would people suddenly decide to hoard money instead of spend it? A possible answer lies in the combination of two issues. A glooming economy after the financial crisis. People are nervous, right? They want to hoard onto that money in case of bad times. They'll have something to hopefully carry them along. The dramatic decrease in interest rates that has forced investors to readjust their portfolios towards liquid money and away from interest-bearing assets such as government bonds. In this regard, the unconventional monetary policy has reinforced the recession by stimulating the private sector's money demand through pursuing an excessive low interest rate policy, i.e., zero interest rate policy. Indeed, during these pre-recession period, for every 1 percentage point decrease in 10-year Treasury notes interest rates, the velocity of money base decreased 0.7 points, based on a linear regression model of the velocity onto interest rates. Since 10-year interest rates declined by about 0.5 percentage points between 2008 and 2013, the velocity of money base should have decreased by about 0.085%, or 85 points. 0.085 points, there we go. But the actual velocity has gone down by 5.85 points, 69 times larger than predicted. That's how slow the money velocity had gone. But this actual velocity has gone down by 5.85%. Oh, I'm sorry. This happened because the nominal interest rate on short-term bonds has declined essentially to zero. In this case, the best form of risk-free liquid assets is no longer the short-term government bonds, but just money, right? Hoarding onto the money. And so that is very much in a nutshell, very quick, to why it is that the inflationary scenario that we should have expected from the quantitative easing 1, 2, 3, and 4, which took the Fed's balance sheet from $850 billion to over $4.5 trillion to create the inflationary scenario, but it failed. Why? Because money velocity had fallen dramatically. Now, what I find interesting is that if you go and you look at the news article that I leave down in the description, they are trying to use the idea that money printer go burr, prices go up. And now in the exact speech that they are quoting from, Deflation and How to Prevent It from Ever Occurring here in the United States, quoting Ben Bernanke from November of 2002, I think is when that speech came out, they failed to address the one key part in that speech that is actually the real information that Ben Bernanke was trying to give out. And that is the idea of the gold machine, the credible threat, the idea of them printing money is going to create inflation. Just saying it. Them printing money, prices go up. Money printer go burr, prices go up. That was what essentially had been pushed out there to the people, everybody's perception out there. There's no other way of looking at it. When the money printer goes off, prices go up. Period. End of story. But yet could not explain how it is that the expansion of the balance sheet that was 4.5 times or better than 4 times failed to produce the inflationary scenario they were looking for. Why? Money velocity has everything to do with it. And although we are seeing, like I said, we are seeing money velocity increasing, it's nowhere near what we had experienced prior to COVID. It is still dramatically low. Even with all this money out there, unless you have people borrowing that money and spending it into the economy, causing that money velocity to increase, you're not going to find where the inflationary scenario is going to be persistent. Now, what we had experienced was a flash in the pan inflation. They severed the supply chain and handed people the helicopter money. But unless that helicopter money is continuously injected into the system, it's going to be spent and it'll be over. Yes, we had an inflationary scenario that occurred during COVID, but the reasonings that occurred was not because of the money printer, but was because of the severing of the supply chain and the stimulus checks that came out that need to be continuous if you want to have continuous inflationary pressures. You need to increase the money velocity, which means that you need to have people borrowing that money into existence and then spending that money to start chasing the goods and services. If that does not occur, then it sits in the bank and doesn't produce the inflationary scenario that everybody would expect. However, if your internal beliefs and everybody else's is saying, oh my gosh, we have inflation, no doubt about it, look at all the money printing, look at all the government spending, look at all this stuff that is happening out there, and your belief, your inflation expectation is elevated, you start performing in the economy as if that inflation is occurring or has occurred, which is then a self-fulfilling prophecy. When that starts to fade away, the below inflation expectation can then become anchored into the economy, and that is dangerous for the Federal Reserve. It is super important to understand that the Federal Reserve is looking for an inflation expectation that is persistently too high rather than too low. Their inflationary scenario was failing them. Quantitative easing 1, 2, 3, and 4 did not have lasting inflationary pressures within the economy, and it's important to understand why. It's because the money velocity had fallen dramatically, and it is still down. Even though it's increased some, it is still dramatically low comparatively to where we were. All right, I left links down in the description to all that stuff. It's great to see you guys here. Lumberjack Landlord, thank you so much for joining in today. We got AG, we got P Nice, we got Paul Walker. I'm not reading your comment, bro. All right. Hey, Dishes, great to see you here. All right, let's cruise it up here a little bit. All night, I love it. P Nice. Daniel, pumpkin spice candles are cheaper this year. Deflation is here. Yeah, sure is. All right, Joe says gold topped out in the long term today, so you will now see gold beginning to telegraph the coming great deflationary got dollars. All right, layoffs are the highest in 15 years. It's over. Yeah, Paul, but I think this is something that I predicted, is that we would have an increased amount of layoffs, but the no layoffed people would then move over to the service industries out there, right? Start bartending and serving tables or doing whatever, because those were in short supply for the longest time. So as people were losing their jobs, they're going to go find jobs over at the service industry, and you're not going to see an increase in unemployment that would be dramatic. So yes, even though you have this huge amount of layoffs, They're actually going to go work at lesser jobs out there. Even though they're not great jobs, they're at least a job, and a job is better than no job. And so will we see a dramatic rise in unemployment? That is still yet to be seen. We should see a dramatic rise in layoffs. That I can imagine, because we've had so many zombie corporations that have developed over the last few years. It would be no doubt in my mind that we would see those companies either trying to survive by cutting off, cutting employment, or even just going bankrupt altogether, which would cause the layoffs to rise. But again, since we had such a huge tightening of the labor force and essentially having jobs that were not being filled, rising the unemployment in lockstep with the layoffs, it may not occur in that same fashion. Like, give it time and it might start to increase, but still we are fairly low on the unemployment scale. On a historical, considering recent times with unemployment, it's really high, but that's not normal. That's like, unusual circumstances. All right, P. Nice. Money isn't created much productivity overall too, sitting in safety. Yep, I agree. What's terrifying me, if the money printer turns on and there is no activity like China is going through, there is very scary scenario. That is a very scary scenario. I agree. Not always. If you have investory, but can shut down and burn through it and then start back up late so you can charge more people to do that. Can do that in Detroit because of bad union deals. Can't do that in Detroit. Okay. If asked for a raise, wondering if it was a bad thing. I don't know. Let's see here. I went to the grocery store. That's where inflation went. And that's what's funny about it, is that people say over at the grocery store, it's all super expensive. And, I don't do a lot of shopping for the household. My wife does all that. And, it's amazing some of the deals that she comes back and says, hey, look what I saved on this. Look what I got here. Got all this stuff on sale. She will load up during times in which that she finds good deals. Now, again, we have the means and ability to store it. We have freezer space. We have pantry space. She knows how to can. So if it was like too much to even fit in the freezer, she can take all that and put it into jars and can it up and stick it in the pantry. So we have ways of dealing with it. And although the food pressure has increased quite a bit, it's amazing on some of the deals that she is finding out there. And when everybody says, oh man, look how the expensive price of food, it was just like, well, yeah, if you look for it, if you look for the expensive stuff, but do you look for the cheaper stuff that goes on sale? I mean, it happens out there. And then when it does go on sale, do you load up? I mean, we were picking up chicken for an incredibly cheap price not too long ago. I mean, pre-COVID prices for sure. Same thing with pork. And now it's not always that way, but then when it is that way, do you take advantage of it? That's, my question that I ask a lot of people out there. So, yeah, I mean, it's at the grocery store, but it isn't in every single thing. If you can find good deals out there, I see them, occasionally. All right, let's cruise it up here a little bit. Brody, hit the like on the stream, please, everybody, because it will make the YouTube share it more widely so we get more interesting questions in here. Yes, absolutely, Brody. Thank you so much. Hey, Chico, do you ever watch while you're working? Okay. Longshoreman strike, supply shock, inflationary, your thoughts? Yes, it can be if it's very persistent. Like if it's a very persistent strike that then starts shutting down ports and activity and all this other stuff for any kind of extent, then yeah, I could see that causing an inflationary pressure. But I believe that would have to be fairly persistent within the economy for a length of time in order to create that gap, right? To make that happen. So I think it'd be better not to just say this is going to occur and that's going to happen from it. It's better to say, okay, how long is this going for, in order to create the bigger effect into the economy, and and to what extent that will be. Because like people were saying, oh man, look what happened. They whatever Suez Canal, whatever, they come up with things. This is going to be inflationary. I'm like, but that's an isolated, I mean, it's a major one, right? But it's like isolated to that. If it was there and then everywhere else is experiencing something very similar to that, then yes, I would say that would be like a broader economic impact. But when it happens to an isolated area, like the damn ship running into the bridge and knocking the bridge down and, shutting down traffic for there, people were like, oh, this is going to be inflationary. I'm like, they'll reroute it. They'll figure it out. That's an isolated thing, although it's major. It's just that one section. If it was happening there and there and there and there all over the place, then I would say, yes, this is going to be a broader inflationary impact. All Nighter says, hey, Brody. Paul, American Recovery Act signed in 2021, paid and authorized to NGOs to facilitate this invasion. We got 1,500 to look the other way. Look it up, planned BBB. All right. Grocery prices are definitely way up, but Simon is right. If you know how to shop, you can cut your food bill in half easily. Yeah, and that's what I'm saying, Joe. It's just like a lot of people are like, no, I used to buy this particular thing, and look how much it's gone up. How do you explain that? You can't, like, okay, yes, that particular item has gone up, all right? But now focus in on things that are not moving up as far as the one thing that you're focused in on. If you are looking for, say, what about this? What about that? What about that? Well, then yeah, you're going to find all this inflationary pressure. It's easy to see, but it's also part of your responsibility as a human to try and find out what it is that you can go to try and put yourself in a better position. To not say, man, I need you, or I need this, or I need this particular thing to come back down to the normal price. That's not the way it's going to work. What you have to do is say, man, what is it out there that I can buy that is more reasonable and, going to fit into my budget? Like, I have to change the way I'm conducting myself in order to adapt to the new situation. And it means that I may not be able to get the same products that I once enjoyed, right? You have to change that around. If you really enjoy that, then you're going to pay the price, Bro, just start an OF account? I don't know what that is. Okay. Gig and part-time work will likely absorb unemployment. However, income and hours worked will likely decrease. Recessionless recession. Yeah, angry capitalist. I totally agree with that. Like, I just recently found, I didn't even know this. I knew it was expensive, the area that I lived in. I live in Astoria, and if you look it up, Astoria is in the top 10 most expensive cities in the entire nation. Wow. So when people are like, man, inflation is hitting everybody, I'm a normal, everyday working dude, right? I work a 9-to-5 job. I have a side hustle that I, call and bingo. And if I hadn't started up YouTube all those years ago, I would be in a position in which that I could not live in this town. Right? I would have to leave this town. This is too expensive of an area. So I understand. I get it, man. I know what it's like to live in an expensive town. I live in what is it? I think it was number 10 out of the top 10 most expensive cities in the entire nation of population between 10 and 50,000 people. I live in it. This is it, right? There are places that are more expensive than Astoria, but not many, right? And what does it take to live here? It takes everything I can do. Like literally everything. And then I wonder how it is that people even make it here. Some people are like, how come you don't go get a new car? It's like, I can't buy a new car. I'm buying a house, man. Like, I can't, the new car, that's not happening for me, right? I mean, I wish, I hope, I dream I could go out there and buy the Camaro anytime I wanted. It would be the only things I have is trying to pay for the Camaro and trying to pay for the house, and it would take every bit of effort out of me. Does that sound fun? No, hell no. That doesn't sound fun at all. So, you know what? The Camaro is going to have to sit on the sidelines for a while until I can figure out a way to now make more money so that I can live in this expensive damn town that I am in. All right? But I love it here. It's clean, it's friendly, it's nice, and I grew up here. My entire network's here, and I don't want to give it up. But yet, I have to live in the most expensive place in the entire in the entire country. It's just like, believe me, I understand. Is the inflation on pause until after the election? If you can internalize that to make it work for you so that you can look at the external and say, what is it that needs to change on the outside in order for me to conduct myself, then I would say go for that. But I don't know how in the world I would do that for myself. because I don't look at the election or administrations or any of that other stuff to create the environment or the economy that we are now experiencing. Now, an individual person can position themselves due to the fact of whoever is in president, who's ever going to get elected, how it is that they conduct themselves can be all wrapped up into this external issue of who is it that is president right now, and then you can find all the facts and all the reasonings that can back all that stuff up. I eliminated that out of my life. I do not care who's going to be president. I really don't. Like, I could take that and just like, it could be any way, because that doesn't really determine what it is that I'm going to be doing going into the future. I look at the monetary policy, I look at the way I position myself, I look at my debt to income ratios, I look at those type of things and what it is that I need to do in order to better myself. Where is it that I need to place those excess funds in order to get some sort of return? And I do not look at the external as far as an administration saying, well, once we have a better administration, I'll be in a better position. That's not the way it works. I look out there at the environment and say, okay, how do I better position myself in accordance to what is taking place out there? No change, don't need to change anything about it. I just need to understand what it is that's happening, and then I can do it. All right, let's go check out this super chat. I only got a few more minutes here, guys. I got literally 1 more minute to go and read this super chat from Felix the Cat 69. Thank you so much for the $5. BRICS used for world trade, not USD, will not cause hyperinflation. TF, is this because the world needs US dollars to settle ongoing outstanding debts? That's exactly what I believe. That the BRICS nations, first of all, think about all the transactions that occur around the world, okay? There is an insane amount of transactions that take place. The majority of all these transactions occur in US dollars. You know why? Because US dollars are available. If we do this deal in some other foreign nation and other people start doing it, and more and more and more people are doing deals in those particular currencies that are outside of the US dollar, what will happen is those currencies will begin to strengthen, and it'll destroy the manufacturing base of those nations in which that currency is strengthening from. Very much like the United States has a very poor manufacturing base trying to get those products out there to the world, is because the rest of the world has demanded the dollars that exist. And with that demand for dollars, what ends up causing it is a strengthening of the dollar, which makes our exports more expensive. It makes their exports cheaper. So when you have a nation who has a particular currency that is growing in strength, their domestic production to try and export to the world begins to diminish. And there they find a problem with a strong economy, because a strong economy is built off of production and savings. The United States experienced that before. We don't experience that same thing. We don't build our strengthening economy off of production and savings. We have an economy that's based off of debt and consumption, which is way different from what anybody else out there wants to do. So those nations do not want to see their currency strengthen. Yeah, they want to do deals outside of the United States because they want to say, hey man, you guys and all your weaponizing of the dollar, we'd like to get out of that. But every one of those nations want to be an exporter, right? That's what they want to do, is export their stuff, their manufactured goods, and import money. That's the way most of them want to operate. But if it comes down to a situation in which that they're not using the dollar, then they have to figure out which one of those is going to have the strengthening currency, and not a single one of them wants that. Even in a situation where you think, okay, I got to end this real quick. Even in a situation, just think back to the Russian-India situation, in which that Russia was selling India a bunch of oil in rupees. Russia ended up with a bunch of rupees. Now they don't know what to do with these rupees. Like, the only place they can really go with them is back to India, because no other nation really wants them. And if they go back to India, they need to buy something from India with those. Well, what if India doesn't have what it is that they are looking for? Then they have to sell those rupees out there to get another currency to buy from that particular country or whatever it is that they want. And when they go to start selling the rupees, they might as well set it on fire, because it starts destroying the value of them. So that doesn't put them in a good position. Think about it in that fashion when it comes to the BRICS nations. None of them want to do that. They all want to be able to export their goods and services and import money. But the only problem with that is that any nation that starts to rise as far as the world reserve currency goes, that exact situation will be destroyed. And that they will become a debtor nation and they will not be a manufacturing, exporting nation. Again, like the United States is suffering the consequences from being massively debt and massive consumption and have no other way of reversing this to go back to a strong economy of being producers and savers. Not likely to occur. All right, I got to go back to work. I wish we could continue this on because I think it's a really good discussion. Thank you so much for hitting that like button. We got 360 people with the $5 super chat. Thank you so much for the support for the channel. Uneducated Economist, links are down in the description. You let me know.